To print or not to print? That is the question. You came here for the truth, so let me unveil that for you. We've heard a lot. The interest rates are going to get cut in 2024. The Federal Reserve is going to print a whole bunch of money in 2024. We are going to see it because A, B, and C. Well, in today's video, I'm going to tell you why the US government itself is going to force the Federal Reserve to print cash. I'm talking about real, serious, unavoidable cash. How does that sound? Stick with me. I'm going to bring it to you. You've probably seen this before with the layoffs going on, the economy of course, not as strong as they tell us. And so massive layoffs are coming in 2024. Survey of 900 companies says that 4 in 10 are planning layoffs, citing the coming recession, and more than half are freezing hires. That comes as of brutal 2023 with layoffs doubling in the year. Biggest hits are tech, construction, finance, and retail. Now that shoplifting is legal. That's what they say here. Okay, so we see that in different industries. It is affecting a lot of different people. And of course, layoffs give a very big signal of what's going on in the economy. So that's one thing. Keep that in mind. What's on top of that is debt. There's a very big problem with debt because when I look at it across the spectrum, it's at the highest it's ever been in every single category. But just having too much debt is not necessarily a problem. It does, though, create more gunpowder or more fuel for the fire. You understand? So just the number being high in any category, whether that's, mortgage debt, whether that's credit card debt, student loans, national debt, a bigger number doesn't necessarily mean it's going to break. But what it does is adds more fuel into the inevitable fire. So let me show you a few things, okay? I got several charts. This is the yield curve inversion that happened, and then as it comes the other direction, the steepening, the uninversion, there's different silly names that they have for it. But what does it mean? Okay. Well, at this time, we are looking at it. We're just seeing it at, in this few days span. You zoom out, you start seeing it, a different story. Okay. What we can tell from this is that when it inverts and then it uninverts or reverts or goes back, it always ends, or in most cases, ends in a recession. What is this? Basically, I've talked about it before, but when you have, let's say, a 30-year bond and you have a 1-year bond, well, the 30-year you would assume would give you a better rate of return than the 1-year. But when that's flipped, that's an inversion. And so that's what's happening today, but now it's going in the other direction. Why? What's happening here? Well, the Federal Reserve is starting to signal that they're willing to cut rates at some point. They're going to stop with quantitative tightening. And that, of course, has an impact on the value of the currency as well as the bond market itself. Okay, a lot of jargon, but keep that in mind as well. So we have the debt. All debt is going to be there with an interest rate attached to it. There's always going to be an interest rate attached to it because you're borrowing it into existence. Imagine this. Debt as a whole, $34 trillion in the US national debt, corporate debt, personal debt, credit cards, student loans. Each and every one of those came up out of the ground, out of nowhere, came right through the sky. Here we go. That's where it is. And that all has an interest rate. What is that interest rate? Well, it depends on that particular instrument at the given time. So if it was a mortgage and they got it a couple of years ago, they got it at a super low interest rate. If it was credit card debt, well, we know that's over 20%. So all the debt has some sort of interest rate associated with it. Got me? Okay? Don't stick with me, okay? I promise. It's all going to make sense. Looking at this is talking about the labor market, unemployed to unemployed, basically just telling us that during these periods of times, we tend to see this. Basically, we start to see the numbers creeping up, and then, of course, a recession hits after. The same pattern is happening right now, okay? But these things don't tell you when that happens, right? It could be a very long time. It could be very mild. It could be very short, or it could be long and painful. It doesn't tell you anything necessarily. But we do have several indicators that are piling up, suggesting that there is a recession coming or it's already on. Federal government spending, 6-month moving average. Looking at it, think about this. We've overspent. That is the United States, that is Canada, that is the UK. Every single government spent way too much money in 2020, and we sort of leaped well beyond where we were on that trajectory. It's already bad. If we were on the same trajectory from back in, let's say those years prior to 2018, 2019, it would have been bad. But it went even further than that. And not to mention the fact that we printed so much money during that period of time, it created so much inflation that we're dealing with today. But now the pace of this is even worse. So the expectation is that what you experienced back in 2020 into the next couple of years after, a lot of inflation, prices rising everywhere, shrinkflation, you know the drill. Well, imagine it's about to get much worse. So that's another piece of the puzzle. You're sticking with me, right? Check this out. Cumulative fiscal budget deficit. So big deficits. A lot of debt, a lot of deficits. At the same time, we've got the potential for a recession, slower growth, unemployment, right? Even perhaps a little bit. Doesn't necessarily, like I said, doesn't have to be a big, bad one, depression, and so on. At least in what I'm talking about here. We have this. 60% of the global economy is in for a lost decade due to record debt. All right. This is for the World Bank. Not from me saying this, but countries cannot service their own debt. All right. So this is where it starts to get interesting. All right. Let me make it very clear. No jargon, okay? When the government needs to spend money because there's a recession, people are out of work, you want to invest in infrastructure, you want to do something that requires a lot of money. And that's happening right now as it is. The government is issuing a lot of debt now. And it's been very unusual to see that usually there's an infinite amount of buyers. Infinite amount of buyers coming to these auctions, these debt auctions, to buy the US debt. They know it's grade A, it's the good quality stuff, and they're able to make sure that, however long they're going to hold that for, they're going to get paid back and the interest rate's going to be good. That interest rate has declined somewhat. The value of the US dollar has declined somewhat since its peak. And there is a big problem. Because if they issue too much debt and they do not have enough buyers for that debt, who then has to come in to save the day? The Federal Reserve. And the Federal Reserve at this point is already starting to suggest little tidbits here and there, not necessarily their official statement that they put out. FOMC says, hey, we're going to cut interest rates and we're going to print a whole bunch of money. You don't get it like that. You get the anecdotal evidence that appears in little interviews with this and that. You get it through the Wall Street Journal that's signaling to the markets what's going to happen, leaked information. And so this happens. The Federal Reserve comes in and they start some sort of program, potentially like what we saw in 2019, which is a backdoor quantitative easing. Doesn't have to come in the form of an outright quantitative easing. The US government could spend a virtually infinite amount of money, and then they have to go out into the world and say, we want people to buy this debt. Come to the auction. Let's make it happen. And they have to give an interest rate that is attractive enough. They can always get more and more. But let's say it's at 4.5% right now. Okay, you want to take on this debt? Here you go. Put in a nice little bow on this debt. You come to the auction, 4.5%. Auction, do I have a 450? Do I have a 450? No? Okay, what about 460? What about 470? Oh, 5%? All right, we'll sell it to you. And so this is the type of thing that could long term basically completely punish and bankrupt the nation, trying to in a sense build up the country, doing this, hey, we're going to spend it and we're going to use it wisely, but then they've got to issue all that debt, not enough people come to the table, or you got to really entice people by having those interest rates high, and at the same time, in the end, they have to monetize that debt because there's just not enough buyers. And so the Federal Reserve does that. The value declines dramatically of your currency, and you, my friends, pay the price. This is the trouble that we are dealing with right now. I just pieced that all together. I hope you appreciate that. You see, for one reason or another, they have to, at some point, then force the Federal Reserve to stop their current programs and then reverse the other direction. Not going to happen tomorrow, but it's going to happen at some point. We have accelerated the pace of this debt, of the expansion and the devaluation, expansion of debt and deficits. But the devaluation of the currency, we've gone at a much quicker pace. So think about this. The cycles run much shorter potentially and could very well become an inflationary problem if we didn't have that already very soon. Keep that in mind. Longer term, what are the concerns we have to worry about? Very simple, that AI, robotics, and automation are disrupting certain industries. This is talking about CES technology show. Well, robot baristas, AI chefs, looking pretty good. In fact, think about it. If you could, wouldn't you want a robot fast food? Like, think about it. I'm not talking about fine dining, but fast food and a barista where you order from your phone, you walk in and there's 10 machines there. They're making it faster. There's no lineups ever. Lineups are a thing of the past. Payment, physical payment, where you got to give money to somebody. They're there, 2 pennies, 4 pennies, 7 pennies. None of that happens. It's an all automated process. And that's the way things are going to go in order to keep the costs down at a reasonable level. People want stuff that's cheap. That's why they have dollar stores. That's why, we're offshoring all the jobs, is because people are unwilling to pay much higher prices. And I understand why. Then we have this also talking about AI and things that are happening. Of course, artificial intelligence being the big one. We're talking about that a lot. All we need to know is that the businesses are investing literally billions and billions of dollars to do it as fast as possible. So you take what you want from that. If you don't want to believe it, that's okay. But understand that billions and billions are being spent by these big corporations. What I have to tell you right now is, number one, hit a thumbs up if you want to support this channel. I really do appreciate that very much. And those who are part of my Sunday live class, they get the key. They get the secret. Because on the Sunday live class, that's where I talk about how to build a business, specifically online businesses, but also to brick and mortar. So you create a physical product and I can help you out with all of that. And that's part of the Sunday live sessions. If you want to know more about that, link is in the description below. Those people will be and are at the cutting edge of the information because of all the sources that I have and the work that I do outside of the Money GPS. I want to thank you for being here. And of course, you got to join me tomorrow. I'll see you then. Take care.